So as you can see, Innoven Capital is a joint venture between Temasek and UOB. Sorry, I was introducing myself just now. I'm a director at Innoven Capital. I've been there since 2016, and since then we've tried to bring the venture debt instrument to the region. Venture debt being debt capital given to startups who are normally reliant on the equity capital. I think venture debt players like us believe that startups, though early, they show the potential and are good companies and are fit for venture debt as well. So a bit about Innoven Capital. Innoven Capital is a joint venture between Temasek and UOB Bank. It operates from 3 offices, one in China for the China market and one in India, Mumbai for the Indian market. And from Singapore, we cover the ASEAN market. So I sit at the Singapore office covering the ASEAN market. In terms of investor commitment into Innoven, we have about $400 million to lend across these 3 geographies. Right. So we've since deployed we've written out, I guess, $500 million in loans to about 200 startups across India, China, and Southeast Asia. I think in Southeast Asia, we've done 60, 70 deals as the momentum of this instrument starts to pick up. All right, so coming into venture debt proper, as I said, venture debt is any form of debt financing provided to a company still dependent on venture capital for growth. Basically, it is like a bank loan given to a venture capital dependent type of company. And we hope that this will complement equity financing of companies. So a bit of illustration of how venture debt may fit in. On the left, you see a diagram that details the fundraising life cycle of a typical startup. It usually starts with seeds capital, and at this time you have angels, family and friends, or even very early stage venture capitalists investing small amounts of money. Typically, companies at this stage have higher failure rates, but gradually some of them break out and then they reach Series A. And as you can see, at the Series A stage, you would attract larger, more institutional venture capital investors, which bring with them not only more money, but more expertise to help the company grow. And as the company grows and scales, it starts to raise different series of equity financing from Series A, B, C. Sometimes it extends to D, E, so on and so forth. It comes a time when the company may either exit via M&A or IPO, and at this time they may explore mezzanine capital, or actually sometimes the company may not explore this exit. It may reach a profitable level and continue operating. As venture debt players, where we target is the red space here, and the companies raising Series A, B, C. Whereas in the traditional banking sort of framework, you would target the company at the later, more mature stages in the yellow region right here. So there's this gap. There's always been this gap at the A, B, C because the traditional financiers look at companies in the traditional sense, looking at collateral and profit, both of which companies at this stage do not have. But as I said, a venture debt player kind of believes that these companies are good based on the fact that they can grow and raise more money. And so we look to fill this gap to be the debt financing option at that level. So a lot of questions come along uses of venture debt. How would you use it in relation to maybe the next equity round? Because these companies are burning money, so to speak. So if we distill all the use cases in a very general sense, I think there are mainly 2. If you see on the left here, the first one is venture debt taken together with a round of equity capital, and it's our preferred scenario. I'm sorry, venture debt taken 3 months after equity round is raised. That's on the left, yeah. In this scenario, a company would raise this round of equity and then find that it's growing better than expected and would give us a call to say, can you please top up a little bit in debt because I could use this money to grow my company. And so after doing so, it takes the money and successfully grows the company, and it can reach hit better metrics and reach a better next round equity valuation than if it didn't raise venture debt. The other one is where a company on the right-hand side here raises a venture debt together with a round of equity as a form of almost like a form of insurance. I use that term very broadly, but basically the thinking here is that I want to supplement my equity round with more money, so I have more money to start with. And because he did that, the runway of the company is probably extended. And because he has a longer runway, he has more flexibility to achieve more milestones or do more things, bringing the business to either to profitability or, as you can see here, allowing it to raise a better round because it has hit more milestones. So moving on, I guess a lot of times we get asked, what do venture lenders look for? And how do we do the underwriting, given that the traditional debt underwriting metrics may be not available? For example, debt to interest cover, or like debt to equity does not really make sense because the company is not profitable. So there's no interest cover or EBITDA loan cover to talk about. So this is what we look for. First, we look for companies that are from a strong shareholding group. Strong meaning we prefer that these companies are backed by top-tier VC firms, followed by even corporates sometimes. Secondly, we look a lot at the financials at the company to determine the cash runway. We like at least 12 months of cash available. So therefore, we do not do what a scenario called the bridge loan, where the company is out of cash and needs small amount of money to bridge it to the next equity round. These are commonly done by the convertible notes, which we do not do. And 3 and 4 is a little bit more qualitative. And on the third point, we look at the competitive advantage of the business. We like category leaders with a comparative and differential type of offerings to its peers. And lastly, we do take a look at the team. We look at founders' background and operational experience. We believe that with these factors, we kind of make a decision as to whether we can lend the company money or not. There is a consideration of timing of a venture debt. That's because in a cash burning startup, the runway is always decreasing over time, and so therefore, the later the company comes to us to raise debt, the less or harder it is for us to give the debt. When you reach a certain point where the runway is too low, the venture debt starts to not become an option for a company already. So, I always tell companies that you should plan to use venture debt even before you raise your equity round. I mean, should debt be a strategy that you want to undertake? And then when the equity round is being raised, you should raise the debt together so that you can get the maximum amount. And so as you can see here, in one, it's a lot of debt that we can do. In two, it gets smaller. Three, even smaller. And then at some point, we cannot do any venture debt already. So I think a lot of times you get compared to traditional bank debt. And so I came up with this slide because personally, when I was working for a bank a long time, I was personally from UOB for some time. And they taught me a lot about the 5 C's of credit. So it's character, capacity, capital, collateral, conditions. So if I apply that to the early stage company, what banks look for in terms of character is no bad track record, no KYC issues, good account history. But the typical early stage company has little or no track record. In terms of capacity, banks are looking for profit and EBITDA to service the debt obligations, but the typical early stage company does not have that, is cash burning. In terms of capital, they are looking for well-funded companies with strong cash balances. In the venture stage company, the cash balance may be strong at the start, but then as time goes by, it will need to raise more capital because they are basically burning cash. And in terms of collateral, the banks look for hard, tangible collateral. However, the early stage does not. And what the banks look for in terms of conditions, a strong market position. And what the early stage company has is really in new disruptive markets. So at Innoven Capital, we take an open mind when looking at this. We provide that as early as the post-seed stage, but really the mainstay of the business at the Series A stage. We understand that most of these companies are cash burning to grow, and we accept it. We measure the risk by looking at the cash runway and also tracking the growth to see whether it can raise more capital. We work with companies that have raised capitals from VCs and institutional investors, mainly because we know the VCs well, and we're able to sort of put a yardstick or get an inkling as to how likely this company can raise that round from these VCs. And based on this, we do not need to look at the collateral because the majority of our portfolio companies do not have collateral to give. And we have to be supportive of new disruptive markets because sometimes that's what will attract new capital. So given this, typical terms that we would do for venture debt is a 3-year loan tenor, or what we like to say 30 to 36 months. Could be shorter, but usually no longer. And the reason for this is that the rate of change in a venture company is very fast, so we would like to keep the loan tenor slightly shorter. The amount of loan we do, we peg it to the equity fundraise or the cash in bank at that time. We're typically doing 20 to 25% of the equity fundraise that we are coming with, or the cash in bank at the time. We do not take any personal guarantees. We don't restrict the use of funds, and that would be impractical because of the fast rate of change. There will be different uses of funds coming up all the time. To supplement our return, we do take a small equity warrant, which is like an employee stock option in the company, to give us some return should the company realize a meaningful exit. We try to be light on financial covenants to give the company space to maneuver, but we do take a debenture over the company's assets to ensure that we are the senior lender. And lastly, we don't take any board seats. That's a Southeast Asian team of Innoven. And I think from here, I think that ends my sort of presentation. And right now, I'd like to hear from the audience, I suppose, what you guys feel about venture debt and what we'd like to know more about venture debt.